Welcome to Talk Tickers. You're tuning in for a breakdown of the latest crucial earnings call.
That's right.
Today, we're diving deep into Allstate's financial performance for the first quarter.
Yeah, there's quite a bit to unpack here.
Our mission, as always, is to extract those essential insights, give you a clear, concise understanding of what's driving their business right now.
And Allstate certainly came out with a solid set of numbers for Q1. Revenue saw a pretty healthy year-over-year increase, up 7.8%, landing at $16.5 billion.
$16.5 billion.
Okay.
And income.
On the income side, they reported net income of $566 million.
Okay. But I think there's maybe more to that net income story.
Absolutely. You know, when we look at their adjusted net income, which, well, it often gives a clearer view of core operational profitability, excluding certain things, that figure jumps quite a bit.
How much?
To $949 million, or 3.53 cents per diluted share.
Wow. Okay. That's a big difference.
It really is. It highlights the impact of those adjustments and, suggests a strong underlying performance. Actually, over the last 12 months, their adjusted net income return on equity is pretty notable.
Which is?
23.7%.
23.7% ROE. Yeah, that definitely gets your attention. And it seems like they're looking to share some of that value with investors.
That's right. They announced an increase in their quarterly dividend. It's up to $1 per share now.
Okay.
And on top of that, they've initiated a $1.5 billion share repurchase program. So that signals some confidence in their finances and future prospects.
And wasn't there an asset sale as well?
Yes, good point. It's important to remember they finalized the sale of their employee voluntary benefits business, got $2 billion for it.
Right.
But that closed on April 1st, so the financial impact, well, it isn't reflected in these first quarter results we're discussing.
Got it. Okay, let's delve into the engine room then, their property and liability business. Sounds like they're not just, standing still. They've got some big strategic moves planned for growth.
Yeah, what's particularly interesting here is this comprehensive growth strategy they're rolling out in property liability. It's built around 5 interconnected components, all really focused on expanding their slice of the market. And a central pillar of this is enhancing customer value by, driving down their own costs.
And are those cost-cutting efforts actually showing up in the numbers?
It looks like it. Their adjusted expense ratio, now if you exclude advertising costs from that, it saw a pretty substantial improvement.
How much?
6.7 percentage points.
Wow. How'd they manage that?
It seems like a multi-pronged approach. Things like streamlining by ending some outsourcing, embracing digital workflows, optimizing their real estate footprint, and, allocating distribution expenses more strategically.
So the big question is, can they keep those efficiencies going long term?
That's always the question, isn't it?
But lower costs, that could potentially lead to more attractive pricing for consumers. That's a pretty clear value proposition.
Exactly. By getting those costs down, they gain flexibility. They can offer more competitive pricing without, wrecking their profit margins.
And they're rolling out new products alongside this.
Yes. They're Allstate branded, affordable, simple, and connected auto insurance that's now available in a significant 36 states.
36, okay.
And there's a companion homeowners product in 6 states too. Plus, they've tailored auto insurance specifically for independent agents. That's now in 31 states.
So with these wider offerings and reach, are they actually seeing an uptick in new customers? Are people signing up?
Yeah, it looks like these efforts to broaden customer access, whether it's through traditional Allstate agents, direct online, or independent agents, it's demonstrably boosted new business compared to Q1 last year.
How much of a boost?
Well, personalized new business, which kind of gives us a sense of individual policies being written, it jumped by an impressive 27% year over year.
27%.
Reaching 2.88 million items.
That's a significant influx of new customers. But, the flip side is always holding on to the ones you already have. What are our retention?
Right. And that's where their Savvy program comes in. Show Allstate customers value every day.
Catchy name.
The aim is to enhance, I think it was 25 million customer interactions this year to try and foster better retention.
So they know it's an issue.
Oh, yeah. While they saw strong gains in new business, it's worth noting that lower auto retention did offset some of that progress. But there is a positive sign here. The overall number of property liability policies in force seems to have stopped its decline. It even showed a slight sequential increase, 0.1%, compared to the end of 2024.
Okay, so stemming the tide a bit.
And their homeowners policies in force, those continue to expand.
All right, let's switch gears and look at how all this translates into their core insurance profitability, the underwriting results.
Okay. So, in the first quarter, their property liability segment generated $360 million in underwriting income. But a key metric to watch here is always the combined ratio. Essentially, how much they're paying out in claims and expenses for every dollar of premium they earn.
And where did that land?
Their combined ratio stood at 97.4%.
97.4. So still profitable, but how does that compare?
Well, it's an increase of 4.4 percentage points compared to last year. So profitability squeezed a bit there.
What drove that increase?
The primary factor was substantial catastrophe losses. We're talking $3.3 billion in gross cat losses.
$3.3 billion
Yeah.
in one quarter. That's a massive hit from catastrophes.
It is indeed. Now, these significant losses were partially mitigated, thankfully. They had recoveries from their reinsurance program, insurance for insurance companies.
Right.
Plus, higher average premiums they earned, some favorable adjustments to prior year reserves for non-cat claims, and positive underlying trends in loss amounts.
Okay, so some offsets. What about auto versus home specifically?
Interestingly, their auto combined ratio was quite strong at 91.3.
91.3, that's good.
Yeah, it benefited from earned premiums increasing faster than losses, largely due to, favorable trends in physical damage claim costs.
Okay.
But on the other hand, the underlying homeowners combined ratio, while it remained within their targeted low 60s range, indicating consistent profitability there, it was obviously impacted heavily by those big cat events.
It really sounds like those catastrophes dominated the quarter's narrative.
They certainly did. Allstate experienced significant cat losses, mainly from, the wildfires out in California, and then a series of severe weather events that hit various parts of the country.
Just bad luck or?
Well, they said the magnitude of these losses was more than 3 standard deviations above their average for the past 10 years. So statistically, a very unusual quarter for cats.
But it sounds like their reinsurance coverage provided that crucial buffer you mentioned.
Absolutely. They got $1.1 billion back in recoveries from their reinsurance program during the quarter.
Oh.
These recoveries were mainly tied to those California wildfires and also the accumulation of losses from multiple events exceeding, I think it was, $50 million each over the past year.
So even with that volatility, they still see homeowners as a growth area.
They do. Despite the, inherent unpredictability of catastrophe losses, Allstate continues to view homeowners insurance as a significant growth opportunity. It does raise an important question for you to consider, though. How well can insurers really balance growth in these cat-prone areas with managing the risks that come with it?
That's a fair point. Okay, moving on to the policy counts and how they're reaching customers. What's the current picture there?
Overall, they have 37.7 million property liability policies in force.
37.7 million. How does that break down?
Well, their auto insurance policy saw a slight year-over-year dip, about 0.4% down to 25.1 million.
Okay.
But their homeowners policy count continued its upward trend. It grew by 2.5% year-over-year, reaching 7.5 million policies.
And it sounds like there's a lot of activity on the new business front, particularly in auto, despite that overall slight dip.
That's correct. Applications for new auto insurance policies saw a substantial 31.2% increase compared to last year.
31% increase in applications. Wow. Across the board.
Yeah, across all their distribution channels. Interestingly, the direct sales channel where customers deal directly with Allstate generated the largest volume of these new apps.
But as we touched on earlier, that retention issue kind of offsets some of this surge, right?
Exactly. The gains from this new business were partially offset by lower retention among existing auto customers. So, consequently, a big focus for them is improving that retention, offering more value, better interactions.
Makes sense. What about homeowners' new business?
That's also growing. They saw a 10% increase in new homeowners business this quarter.
Okay, let's talk about how Allstate is managing its investments. That's always a crucial piece for an insurance company's financial health.
Right. Their investment portfolio, it's strategically built to be resilient in different market conditions, and it's aligned with their risk and return goals.
How's it structured?
It's pretty well diversified. About 85% is in publicly traded securities, which gives them flexibility to adjust things as markets change. And they use an active management approach, meaning they're aiming to generate better returns than just tracking market indexes, and also to build resilience against potential downturns, not just passive investing.
They highlighted a proactive approach to managing risk. Can you give us some more detail on that? Any examples?
Yeah, what's notable is their example from late 2021. They anticipated pressure on auto insurance profitability because of rising inflation, and they saw high valuations in the stock market.
So what do they do?
So they proactively reduced their exposure to public equities, and they also shortened the duration of their fixed income portfolio, basically making it less sensitive to rising interest rates.
Smart move in hindsight.
Seems like it. Then, as bond yields went up later, they strategically extended duration again to capture those higher market yields.
So actively managing it. Where does the portfolio stand now?
Currently, over 81% of their investment portfolio is in assets that generate income. And they mentioned the returns from their active investment allocations have consistently performed well compared to their peers, like upper quartile managers.
So that active management seems key for them.
It really is for insurers needing returns to meet policyholder obligations.
Okay. Beyond their core insurance, Allstate also has this segment called Protection Services. What does that actually cover?
Right. Protection Services represents additional avenues for growth. They do this through partnerships with various businesses, retailers, auto dealers, mobile carriers, that kind of thing.
But what products are we talking about?
Things like extended warranties, identity protection services, roadside assistance. You might know their Allstate Protection Plans, which used to be Square Trade.
Oh, right, Square Trade. I remember them.
Yeah. That business has seen a remarkable growth since Allstate acquired it back in 2017. Its customer base has more than quadrupled,
Yeah.
now serving 162 million customers across 18 countries.
And the Allstate brand helps there.
Definitely. They said the strength of the Allstate brand is proving beneficial in securing these distribution partnerships with major retailers.
Is it contributing much financially?
It's becoming more significant. Over the past 12 months, this segment generated $162 million in adjusted net income. That's apparently a seven-fold increase compared to 2018.
7 times?
Yeah.
Okay, so it's a growing piece of the puzzle.
Absolutely. Illustrates its growing importance to the overall business.
Shifting focus now to the competitive environment. What's the pricing landscape looking like in auto insurance specifically? Are things heating up, cooling down?
Well, currently, the auto insurance industry as a whole seems to be experiencing pretty good profitability, and the pace of rate increases is moderating compared to what we saw in recent years.
So fewer massive hikes.
Seems like it. Allstate doesn't foresee any aggressive price reductions in the near term.
What's driving the improved margins then?
Factors like favorable trends in accident frequency, maybe fewer accidents, and a slowing in the rate of increase for physical damage claim severity, those are helping.
So they see the market as pretty rational right now.
That's how they characterized it, yeah. Rational from a pricing perspective.
It sounds like keeping a tight lid on expenses remains a constant theme for Allstate.
Absolutely. There's an ongoing, consistent focus on lowering expenses, both, as a percentage of revenue and in absolute dollars.
How are they doing that now?
They've recently launched a new initiative aimed at further digitizing operations and eliminating manual processes, trying to drive more efficiency that way.
What about advertising spend? That can fluctuate.
It does. Their spending on advertising is adjusted dynamically based on, growth opportunities they see and market conditions. They mentioned Q4 of 2024 saw higher ad spend when they were testing new strategies.
But they track the return.
Oh, yeah. Ultimately, all advertising investments are closely evaluated for their economic return. They're not just throwing money at it.
Reinsurance seems like such a critical tool in their strategy for managing those big potential losses we talked about.
It really is. Their comprehensive reinsurance program plays a vital role. It reduces the amount of capital they need to hold and helps smooth out the earnings volatility from those large, unexpected losses like the cats this quarter.
Did they make any changes to it recently?
They did. They recently increased the total limit of their reinsurance coverage by a significant $1.5 billion.
$1.5 billion more.
Yeah, that's a 21% increase. It brings their protection against a single catastrophic event up to $9.5 billion now.
That's a huge amount of cover.
Yeah.
Must be expensive.
Interestingly, they said the cost of this increased reinsurance coverage is actually down on a risk-adjusted basis.
Oh, that's favorable.
Very favorable. And, the growth they're seeing in their homeowners business kind of necessitates this increased level of reinsurance protection anyway.
Makes sense. Let's touch on how Allstate is thinking about deploying its capital overall. Where are the priorities?
They seem pretty comfortable with their current capital position, indicated they have a substantial amount available.
And the priorities for using it?
First and foremost, investing in growth opportunities, then returning capital to investors.
So that $1.5 billion buyback fits into that.
Exactly. They stated their comfort level with that program, and they mentioned their assessment of capital needs uses a, well, sophisticated economic capital framework. It considers both investment risks and insurance risks.
Do they account for market shocks?
Yes. They said they also maintain a buffer of stress capital specifically to absorb potential market volatility.
Okay. The insurance market in California has been particularly, let's say, dynamic recently. What's Allstate's perspective on operating there?
Yeah, California is always interesting. They noted that the challenges some competitors are facing, particularly in the homeowners market there, could potentially have an indirect impact on auto insurance bundling strategies in the state.
So is Allstate pulling back on homeowners there too?
They remain cautious about aggressively expanding homeowners in California until they have, greater confidence in their ability to recover costs through adequate rate increases. Regulation is key there.
But what about auto insurance in California?
Their auto business in California is actually profitable from an underwriting standpoint right now.
Oh, okay.
And they are open to writing new auto business there, especially given they've had some recent approvals for rate increases. So it highlights the complexities, right? Operating in a heavily regulated and cat-prone market.
Definitely. Another potential factor floating around is tariffs, macroeconomic stuff. How is Allstate viewing the potential impact of tariffs on their business?
They anticipate the potential for maybe a mid-single-digit percentage increase, possibly higher, in the severity of auto insurance claims.
Why?
Because of the impact of tariffs on the cost of vehicle repairs and parts.
Right. Does that hit immediately?
They caution that the actual timing and the full extent of this impact, well, it's still uncertain. It'll likely take time to filter through the supply chain.
But they're planning for it.
Yes, they're actively factoring these potential cost increases into their pricing strategies already.
What about home repairs? Same issue.
They expect home repair and replacement costs to increase too, although likely less than auto-related costs. They also express some hope that tort reform efforts might help offset some of these cost increases.
So overall, how big a deal do they think tariffs will be?
Overall, they seem to believe the potential impact is manageable from an enterprise standpoint, something to watch, but not a crisis for them.
Okay. Customer retention seems to be a recurring theme, something they keep coming back to.
It is indeed a key area of focus, as it should be. Their Save program, we mentioned it earlier, is specifically designed to address what they see as the primary drivers of customers leaving.
Which are?
Price increases and unsatisfactory customer experiences. No big surprise there.
So what are they doing about it?
Their efforts are centered on improving affordability, enhancing the quality of interactions with customers, and encouraging bundling of multiple products, home and auto together.
Because bundled customers stick around longer.
Typically, yeah. Bundled customers tend to be more loyal. While they've seen some stabilization in retention rates, they did acknowledge it's still down compared to last year, so more work needed there.
Right. Finally then, how is Allstate approaching that classic balancing act between pursuing growth and maintaining profitability? Can they do both?
Their stated goal is absolutely to achieve both: profitable underwriting results and sustainable organic growth.
Do they think they can outperform?
They believe Allstate has the potential to operate with a better combined ratio, meaning, greater underwriting profitability than the industry average, while simultaneously expanding their business.
And growth helps the stock.
They also view achieving growth as a crucial factor in improving their valuation in the stock market. So it suggests a strategic focus on efficient growth that benefits the bottom line and makes them more attractive to investors.
Okay. That brings us to our segment. This is not financial advice.
Always important to stress that.
Absolutely. Given Allstate's strong Q1, their clear strategic focus on growth in property and liability, especially those affordable auto products, and how they used reinsurance to handle those big cat losses. Here's a speculative trade idea. It blends the seemingly stable with potential disruption.
Okay, let's hear it. Outrageous but plausible.
Consider going long on Allstate stock.
Okay.
Simultaneously, consider a short position in, say, a publicly traded vehicle inspection company, specifically one whose revenue relies heavily on mandatory annual inspections in states with, let's say, challenging insurance environments, maybe prone to high fraud or litigation.
Interesting angle. What's the rationale there?
The rationale is that Allstate's increasing competitiveness and focus on efficient underwriting could let them gain market share in these complex states. This might lead to fewer vehicles being insured by, let's call them higher risk or less scrupulous players who might rely more on lax inspection protocols.
So fewer dodgy cars needing inspections potentially hurts the inspection company.
Potentially. It could negatively impact the inspection company's volume. But, and this is highly speculative.
Absolutely. Lots of ifs there.
Huge risks related to regulations changing, market dynamics, the specific business models involved. So again, always conduct your own comprehensive research. Talk to a qualified financial advisor before making any investment decisions. This is purely hypothetical.
Got it. Well, that concludes our deep dive into Allstate's first quarter earnings call. We've tried to distill the most important info and give you some context for their recent performance and where they might be headed.
Hopefully that gives you plenty to think about.
Yeah, we encourage you to consider these insights and how they might fit into your own understanding of the insurance industry landscape. Thank you for joining us on Talk Tickers.
We'll catch you next time for another earnings call breakdown.